Hello, everybody. Welcome to my take on your Daily 5 for the 17th of March. My name is Julius de Kempenaer and I'll be hosting the show today. In case we have never met, virtually or in person, I am a senior analyst here at StockCharts.com and the creator of relative rotation graphs. These are the swirly charts in which we can visualize the rotational character of markets. Most of the time we call them RRGs. You can find my contributions in the RRG blog on the site, as well as on StockCharts TV, where I host Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. If anything related to sector rotation and relative strength has your interest, please check out these resources, or even better, subscribe to them so you will get notified when new articles and episodes have been uploaded. I do enjoy the interaction with viewers and readers, so if there's anything you want to share, please make use of the comment sections below articles and videos when you're watching on YouTube or reading on the site. Or simply drop me a message via email if you're watching on demand, for example. But for now, let's have a look at a few of those RRGs and maybe try to find some stocks that are worth further investigation as a possible opportunity. Today, I want to focus a little bit on the rotation of the consumer discretionary sector. And the first RRG is the one here on the left, showing the standard default RRG showing US sectors. These are the cap-weighted sectors. And if you look at the rotation for consumer discretionary here, you will see that the tail has just moved into the lagging quadrant. And that's going on for a couple of weeks already. We're looking at the weekly RRG. So it's going on for a couple of weeks already. If I scroll that back, you can see that we had a very nice rotation back up to leading, and it looked all good for consumer discretionary. And then pretty rapidly, the tail hooked and started to move into the lagging quadrant. And that's going on for 1, 2, 3, 4 weeks ago we hooked and we're now 3 weeks into the lagging quadrant. That suggests that the consumer discretionary sector is a weak sector. And if you look at this tail, then that is true. Those of you who follow my blogs and watch Sector Spotlight every Tuesday, then you may have noticed that I, from time to time, try to look at universes from a different angle. And what I recently did, following a guest appearance in Tom Bowley's show at Earnings Beats, is introducing the RRG for small caps. So it's the same classification, US sectors, but these are all S&P 500 stocks, and if you look at the RRG on the right, this is the RRG for small cap stocks, which obviously shows the RRG for small cap stocks, or non-S&P 500. And most of the time, these tails move largely in the same direction. But sometimes they don't, and when they don't, that's when things get more interesting. And that's enabled us to pick up the differentiation, the difference between the rotation of XLY and PSCD, which is the small cap consumer discretionary tail. And this tells you a completely different story. It's actually rotating more or less opposite, telling you that the small cap segment of consumer discretionary is doing much, much better than its large cap equivalent. So that's one thing that I want you to note, and you can look back. I wrote an article about that. Today or this week, I also had a look at the equal weight version of U.S. sectors. That's yet another angle of looking at U.S. sectors. So it's the same group. So these are actually the S&P 500 stocks. So these two are covering the same stocks, but the right one is equal weight. And if we now highlight the tail of consumer discretionary, we can again see a big difference, because this is actually rotating through weakening, came from a long time ago, came from leading and now went through weakening, and it's curling back up and actually on its way to crossing over into the leading quadrant again. So this suggests that consumer discretionary is a really strong sector, as opposed to this one here, where discretionary is actually moving into lagging. Now, discretionary is a pretty special sector because it's got two stocks in there that are super important, and those are Amazon and Tesla. And without even looking at the individual charts for those two names, I can tell you that the consumer discretionary sector is actually a pretty good sector as long as you stay away from Amazon and Tesla at the moment. If we dive into the members of the consumer discretionary sector and throw them at an RRG, then this is the image that you get. And you can see that there is a predominantly trails moving into the northeastern direction, and this one here of Tesla is standing out and sort of offsetting all the others. What I've done here is I've singled out three tails that I think are worth our time, or maybe most interesting. And they are Tesla, General Motors, and McDonald's. In general, if you look at the RRG and browse through, then you will see that a few of the auto companies like Ford, GM, KMX are actually doing pretty well. They're all showing very nice rotational tails. Also, the holiday recreational sector like Booking, Wynn Resorts, Expedia, the cruise lines, CCL, RCL, they're also looking pretty nice. They're showing nice tails. If I go over these three stocks, then they represent the three different categories. Obviously, Tesla is the one that we like to avoid at the moment. And the reason is that its relative strength deteriorated. You can see that the RS momentum is already below 100 and pulling the RS ratio down. And you see this nice curly tail that moved back into weakening. And for the first time, the relative strength on here started to really roll over. And also the price chart is not the best anymore. You're seeing some signs of weakness there, and it doesn't seem to turn around very quickly. So I'll be very careful with Tesla for the time being. The second one is almost the complete opposite. That's General Motors. And you see a break to new highs already late 2020. And just recently, we are breaking out of this short consolidation and starting to move higher while holding above previous highs, while the relative strength actually started to move nicely higher. And it's not even at its highest level ever. RRG lines just bottomed and starting to push again. That is creating this rapid curl back into the leading quadrant. So GM is actually starting a new up lag in the already rising relative trend. And that brings me to the last one, which is McDonald's. And that chart actually looks pretty good. The relative strength, not so much, but it is turning around. It's at support, but what I really like is that it's close to the center and it's starting to move into improving. It's an early call. So Tesla is a pretty defined negative. General Motors is on the way up and the train is riding. And we've got McDonald's here that is pretty much just pulling out of the station. It's an early call. It's dangerous, but the break here I think gives us enough reason to get on board with support around 216, and if it takes out 230, then we're going higher, and relative strength will be pulled higher as well. So these are the three stocks together with the RRGs that I wanted to show you today. This concludes your Daily 5. I hope you enjoyed the show. If you did, you know what to do. For now, stay safe, and I hope to see you back soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.